Analyzing balance sheets. Here we're going to look at how we get into the analysis of balance sheets. As you know, balance sheets have assets on them, and some of those assets are those which we cannot touch, which are of course referred to as intangible assets. An example of an intangible asset is also goodwill, which is a special type of intangible asset, which we will look at separately. Balance sheet also holds your investments in financial instruments, and we will be looking at how the accounting treatment is done for those. Then on the liability side, we will be looking at our long-term liabilities or our non-current liabilities. And finally, we will talk about ratios and common size analysis, just like we did for income statement analysis. So as you already know that your balance sheet has assets, liabilities, and equity, and usually it is presented in a format where assets are on the left, top left, liabilities top right, followed by equity, or they could be in a sequence as well, with assets followed by liabilities and equity. And usually the flow of any company is that first you will have common stock, which is your original investors, your shareholders. Then maybe you can have like a bank loan, which is going to be a liability. And then all of this money naturally is going to be coming on the asset side as well, which initially could be in cash, and then later you could use that cash to buy assets, other assets such as property, plant, and equipment. So your cash can then be used to start building your business. So what are assets? And as we know, the accounting equation, which is assets is equal to liabilities plus equity. And in the previous slide, we discussed that a company started with 10 million equity and 10 million liability will always have 20 million of assets. If the value of these assets go down, then either your liability has to go down or your equity has to go down. This equation must always remain balanced. And hence the word balance sheet, because the assets have to always equal the liabilities and the equity. So what are assets? Assets are what the company owns. You can think of it in terms of the resources that the company owns. The company is its own person. The company is a legal person, and these assets are under the ownership of this company. These are the resources of this company. Now, where does the company get money from? The shareholders or bank loans, right? These are the sources of capital for the company, and what the company does with that capital is it invests it in its resources. So assets are what the company owns, and liability and equity is what the company owes to others, to the providers of its capital, to the sources of its capital. Definition of an asset is anything which will give future economic benefit to the company. Whereas liabilities are anything which will result in outflow of economic benefit. Now, what does that mean? Let's say on the asset side, you have cash or inventory or even your property, plant, and equipment, whereas on your liability side, you have a bank loan, right? Or you could have an accounts payable where you've bought some material from some supplier and you have to pay them. So cash can give you future economic benefit. You can spend it, you can use it for something. Inventory can be sold for cash. Property, plant, and equipment can be used to make equipment or to make inventory, which can then be sold for cash. So assets lead to inflow of economic benefit, whereas bank loan you will have to pay, which means outflow of economic benefit. Accounts payable you will have to pay in future, so outflow of economic benefit. This is what the company owes, and this is what the company owns. And of course, your equity is the residual interest, which is your assets minus your liabilities. And this is just your accounting equation, just worked around a little bit, where we said assets is equal to liabilities plus equity. And if you want to make equity the subject of the equation, all you have to do is take liability on the other side, and you have equity is equal to assets minus liabilities, which we also call net assets, net of liabilities. This is the residual interest, that this is the residue, that you take the assets, you pay off all the liabilities, and what is remaining is the residual interest in the company, which is owned by the owners, the shareholders, and this is known as the shareholders' equity. Now, what are the limitations of financial analysis of balance sheets? First of all, the assets on the balance sheet and the liabilities on the balance sheet are not always shown at their fair value. What does that mean? So let's say on your asset side, you have cash. Of course, cash is going to be shown at whatever value it is, and that is as close to fair value as you can get. You will have your inventory. Now, inventory is going to be shown at cost, which means whatever it costs to manufacture that inventory, to produce that inventory, that is the amount it is going to be shown on your balance sheet. Is it currently worth that much? Not necessarily. It could be worth a lot more if prices have gone up in the market. Then in the current high price environment, maybe it will cost more to produce similar inventory. So it is possible that that inventory is worth a lot more than it is shown on the balance sheet. And even more importantly, if you look at property, plant, and equipment is also shown at cost, but that land which was probably bought maybe decades ago is probably shown at a very, very low cost. The current market value of that land will be much higher, right? So balance sheet assets are shown at cost. Many types of assets are shown at cost. A lot of assets are also shown at fair value, and we will discuss what types of assets we show at fair value when we get into the financial securities and financial assets discussion. But not all assets are shown on the balance sheet at fair value, and therefore the ones that are shown at historical cost do not give a true picture of what they are worth. Similarly, when we talk about the date of the balance sheet is a snapshot. This is something we've discussed in earlier learning modules, that it is not like an income statement where you're having a certain data for any given period or a year. This is as of a certain date. Now let's say this is as of the 31st of December 2023, and you are in somewhere in Feb 2024, and you are analyzing the balance sheet of a hedge fund. Now naturally, hedge fund invests in financial securities, and financial securities prices can change a lot in 3 months or 2 months. So what you will be seeing on the balance sheet is going to be 2 months old information. So that is the second limitation with balance sheet, that these values might have changed between when you are analyzing them and whatever was the reporting date at which the balance sheet has been provided to you. And the third thing is that a lot of assets are just not there on the balance sheet. And the reason for that is something we've already discussed in previous learning modules, and we will discuss in more detail in this one as well, is that internally generated intangible assets. And in the previous learning module of income statement analysis, we talked about capitalization versus expensing. So when we talked about capitalization, we said that US GAAP and IFRS don't always allow you to capitalize certain costs. If you're paying for development of certain assets, right, then there are very, very strict rules in place that either allow you or don't allow you to capitalize those costs. And specifically, when we talk about intangible assets, which are internally generated, such as you're developing a brand, you're marketing in one of your brands, you're developing that value of the brand, or you are developing certain relationships with your customers, or you're developing human capital in your employees. Of course, these are all very good things. These are definitely an asset of the company, but you cannot show these assets on the books because there are very, very strict rules in place in both US GAAP and IFRS that you cannot capitalize these costs, and therefore they will not show up on the balance sheet. Here is a sample balance sheet, and let's analyze it in a story starting with the formation of the company. So when the company is formed, the money that the shareholders put in, that is called capital stock. It is also called common stock, right? It is also called common equity. This is how the company is started. Now, over the years, as the company generates profits and the shareholders don't withdraw those profits and they leave it in the business, that is called retained earnings, right? These two together are known as your common equity. Of course, the business can take certain loans, and that is your bank loan. They can even issue bonds. Here, the term that is used is notes. And technically speaking, notes and bonds are not exactly the same. Notes are usually lesser maturity. So, for example, if I were to tell you the technical definition, it would be less than 1 year maturity, which means you get your money back within 1 year, are called bills, right? So if the government borrows from you and they pay you back your original investment within 1 year, they're called treasury bills. If it is between 1 to 10 years, it is called treasury notes. And if it is greater than 10 years, then it is called treasury bonds. Now, usually what corporations issue are bonds, but on the financial statements, what we are using, the terminology is notes payable. So this is something that is a bit of a gray area, that even though these bonds are probably greater than 10 years, but we're still writing notes payable. However, just keep this in mind that notes payable is a reference to the bonds that the company has sold, and this is your liability because of course you have to pay back the principal on those bonds. You might have taken certain mortgages, right? Maybe the office space has been leased and you need to pay those mortgages. What is deferred income tax? This is something we're going to talk about later in a little more detail, but I'll just give you a high level introduction right now, that this is money that will have to be paid to the government in the future. The government hasn't asked for this tax yet, but it has been deferred. It is just delayed it will have to be paid in the future. So hence this is also a liability, but it's a long-term liability because it is going to be paid maybe 2 years from now or 3 years from now, but definitely more than 1 year from now. And that is what differentiates current with non-current. So all of these long-term liabilities are non-current liabilities, and all of these on top are current liabilities. And what differentiates current from non-current? Current means within 1 year or within one operating cycle, which usually is within 1 year for most companies, unless you're like Boeing or some ship manufacturing company, which the ships for the sea, which takes more than 1 year to manufacture and sell. So usually companies' operating cycles are less than 1 year. So current liabilities are those that need to be paid within 1 year, and non-current are those which need to be paid after more than 1 year. Now, on your bonds, certain interest has to be paid every year. So that is why there will be a current portion of that bond, which is showing in the current liability. The taxes payable also, which are payable within this year, are showing under your current liabilities. The interest on the bank loan, which has to be paid this year, is showing as interest payable. And this is your salaries for this year. And this is your trade payable or accounts payable, which you have to pay to your suppliers. Now let's come on the asset side. The trade receivable or accounts receivable. This is from your customers who you sold goods and services to on credit, and you are to receive money from them. This is the cash you are holding. Certain companies like to keep some cash in investments, because obviously cash doesn't pay that high a rate of interest. Maybe they have some extra cash lying around, and instead of keeping it in just a low interest paying cash account, maybe they will put it in some short term investments. Of course, every company is going to have certain inventory if they are in the business of manufacturing or trading. And there are some things called prepaid assets, or you can call them prepaid expenses. Now, these are expenses, but they're showing as assets because they haven't been utilized as yet, and they will result in a future economic benefit. So, such as prepaid rent. So, you've prepaid the rent of your office, or prepaid insurance, that you've prepaid the insurance and you will get the benefit later, but within the year. So, anything which is going to result in future economic benefit is an asset. You can have long-term investments such as in those of stocks, or maybe in some savings plan with an insurance company. And of course, you can have your property, plant and equipment, which includes land, building, of course, at carrying value. So this is the original cost 150 and net of depreciation. And this is something we've already discussed in earlier readings, that the depreciation gets accumulated. And what we show on the books is the net of depreciation value, or the carrying value. This is the value at which the asset is carried on the balance sheet. Then you have your intangible assets. Now you might be thinking that I just told you that you are not allowed to capitalize intangible assets. And you're right. You're not allowed to capitalize internally generated intangible assets. But this goodwill is not internally generated. This is probably one of the companies that they acquired. So this company, whatever it is, let's say it's called ABC Corporation. It probably acquired XYZ Corporation, and it paid a higher value than what XYZ Corporation's market value or fair value was. And that extra amount that they paid, which was not showing on their balance sheet, on XYZ's balance sheet, is for the goodwill of XYZ. So this is how goodwill can come on books, only if you acquire it and then therefore you set a value to it. Then you can show it on your books as an asset, and we will talk more about this in detail. We're going to talk more about most of this in detail as we go through this learning module. And finally, you can have other assets such as a receivable from an employee, just a sort of a miscellaneous over there. Right. So what are current assets? Expected to provide economic benefit or to be used up or to be converted into cash within 1 year or in one operating cycle, right? Whichever is greater. And usually for companies, 1 year is greater because operating cycles are usually less than 1 year. Unless you are like Boeing or Airbus or like one of those ship manufacturing companies which have a very long operating cycle. And those assets which are not expected to be converted into cash within 1 year are obviously then going to be called non-current or long-term assets. Similarly, on the liability side, those that are expected to be paid within 1 year or one operating cycle, whichever is greater, are going to be called current liabilities, and the ones which are going to be paid in the long term are called long-term liabilities. So what are we going to discuss in this learning module? First of all, how do you account for intangible assets on the balance sheet? What is the treatment for goodwill? How do we value and measure financial instruments on the balance sheet? What impacts do they have on income statement as well is something we will discuss. And finally, we will talk about non-current liabilities, how they are shown on the balance sheet. And finally, we will close with a discussion of financial ratios and common size analysis. Okay, so let's get started with intangible assets. Now, intangible assets are something you cannot touch, such as patents, licenses, trademarks. And I like to give the example of a biotech company doing research on the cure for cancer, right? All the money that they are spending on this research and development is focused towards getting a patent for the medicine for the cure of cancer, right? That is an example of a intangible asset, right? Something that lacks physical substance, but of course it is definitely worth something. So intangible assets can either have a finite life or they can have an infinite life. So if they have a finite life, let's say you make a patent, but then that patent is not going to be forever and ever. Maybe the court will grant you a period of 30 years that only you will be able to sell that medicine for 30 years. But after 30 years, it will be open for other pharmaceutical companies to also then manufacture that medicine. So what you will do is that, let's say, a large company like Pfizer acquires this small research company once they come up with this cure. So they develop a patent, and as you know, it's very, very hard to capitalize these costs. Well, it's impossible under US GAAP. IFRS still is a little bit lenient on this. But as we discussed in the previous learning module, that the only exception US GAAP gives for capitalization of internally generated intangible is for software development, right? IFRS, of course, is a little bit lenient on that, and we will discuss this in more detail shortly. But what I want to talk about right now is the amortization process of this intangible asset with a finite useful life. So let's say this small research company develops the cure for cancer and it gets a patent for it for 30 years. Then a large pharmaceutical company like Pfizer acquires this patent, and once the large pharmaceutical company acquires this and it pays, let's say, $1 billion for it, then this asset will be shown on the balance sheet of Pfizer as the price or the cost that it paid for it. Now it is allowed to show it because this is not internally generated by Pfizer, it is procured, it is acquired, and hence it can show that asset. But this asset is only worth something for a finite useful life, right? 30 years. So every year it has to be reduced, it has to be amortized, not depreciated, because depreciation is for physical assets. This is not tangible, it is intangible. Therefore, the word we will use is amortization. So that is your example of intangible asset with a finite useful life. Another example I can give you where it is an indefinite useful life, such as, let's say, the brand name. So the Chinese company Lenovo bought the brand name ThinkPad from IBM, right? And the brand name ThinkPad doesn't have a finite useful life. It is something that can be indefinitely used by Lenovo to sell its laptops to a certain target market that likes ThinkPads. Now, here we're not going to amortize this because the useful life is not finite, so we don't have a basis for amortization, but we do check it for impairment. Now, what does that mean? And I told you about impairment in the previous learning module, that when there is an unexpected reduction in the value of an asset, like for example, you're a trucking company and you have a fleet of trucks and one of the trucks gets into an accident. Now, when they are being used on a daily basis, you're depreciating them based on a certain useful life assumption. But if one of them gets into an accident, then it will be impaired. So similarly, when Lenovo bought the brand name ThinkPad, it had a certain assumption that, oh, it's worth 1 billion for me. But then there is a process and it is called an impairment review that your auditors do annually, and they check that, okay, what was your assumption to say that this brand is worth 1 billion for you? And of course there is certain logic behind that assumption that, oh, we will be able to sell these many laptops because of this brand name in the future and therefore it is worth this much. But then if the auditors are able to say, no, you're not going to be able to sell that many laptops, so you are unable to sell that many laptops, maybe because the newer generation just doesn't have an appreciation for the brand name anymore or something like that, so then the value of that brand will have to be impaired. So that is how you deal with intangible assets which have an indefinite useful life. So what about the ones that are developed internally? Very, very difficult to capitalize them. Most of it will be expensed, right? So what is written over here? Costs to internally develop intangible assets are generally expensed. Although there are exceptions, I would rather add over here, there are very few exceptions, and especially under US GAAP there is only one exception, which is software development, but in IFRS there are some more possibilities. So for internally developed intangible assets, you have R&D, right? So there is research and development. Research, there is no hope. 100% it will be expensed, right? Because in the research phase, you haven't even established a technical feasibility. So IFRS allows you to capitalize your costs, but even IFRS says you can only do that once you've established a technical feasibility. And in the research phase, that feasibility does not exist. So research costs are always going to be expensed, always. However, in the development phase, there is a possibility of capitalizing those costs, right? And how that happens, if you are looking at IFRS, then you can capitalize your development costs subject to the establishment of the technical feasibility and the intent to sell the asset. That, let's say, for example, going back to the cancer research company, if they are based in Europe or the UK, which means they are reporting as per IFRS and not US GAAP, then they have a chance of being able to show that asset on their balance sheet if the technical feasibility has been established, the patent has been granted, and somehow they have been able to prove that it is worth that much, right? However, under US GAAP, there is no hope for that cancer research company, because under US GAAP, both research and development costs are expense. There is only one exception here, and that is for software development. That is software development. And even in that, US GAAP is very strict that only the money spent on developing the software, not its feasibility, not its marketing, just the core software development cost can be capitalized as an asset. And that even only if that software is going to be sold to somebody else. It is developed for some third parties, not for internal use. Anyhow, if you purchase an intangible asset, of course you can show it on your balance sheet, right? So if Pfizer acquires that patent from the small cancer research company, right? So maybe the cancer research company was not able to show it, but once Pfizer acquires it, then Pfizer can show it on its balance sheet, because it has paid for it and the value has been established. And that could be a patent, it could be a certain licensing agreement, or maybe something as simple as a customer list. But it has to be separately identifiable, whatever it is. Now let's enter into a very, very interesting perspective of this. And I love to give the example of Facebook acquiring WhatsApp. What a deal. What a wonderful deal. And it's such a practical scenario that we can discuss, and it will really help you understand this whole concept. So now naturally, WhatsApp balance sheet was showing like $500 million in assets when it was acquired, and Facebook paid like $19 billion, right? Which is 19,000 million. So how much did they pay extra? Approximately $18,500 million. Now, I want to explain so many different concepts using this example. First of all, one thing I want to explain to you is that this 500 million is the book value. What does book value mean? That what is showing on the balance sheet, on the financial statement or the books of the company, right? So if WhatsApp is saying my book value, and when I say book value, I mean assets minus liabilities, or the net assets, right? That whatever are your assets minus whatever are your liabilities. So the net value shown on your books as per the book's value of your asset and the book value of liability is 500 million. Now, first of all, the fair value of these assets can be different from the book value. Maybe because the assets are showing at cost, their office, their computer equipment, their land, whatever, they will be showing at cost. So maybe you can have an adjustment to the book value, bring it to market fair value. And let's say that comes to 600 million, right? But it's not going to be that much of a difference, because you're still not bringing the internally generated intangibles over here. You're not going to be something which is completely unidentifiable. So what is the difference between an internally generated intangible, like we were looking at in the previous slide? Let me just go back and show you. So stuff like licensing agreements or patents or customer lists, which are separately identifiable. And then you have this something which is unidentifiable, right? It's not a customer list. It's not something which you can separately identify, but it's just the goodwill of a company, just the general network that it has developed, or a certain goodwill that it has established. And that is not going to be showing on the books, neither in the book value nor in the fair value, because the fair value is just going to adjust whatever is showing on the books. So now, even if I take the market fair value of these assets, which is 600, I am still paying 18,400 million more. And this, my friends, is called goodwill. So goodwill is basically what you pay more than the fair value at acquisition. Please be very careful. It is not more than the book value. it is more than the fair value. So first the book value has to be brought to fair value, and then if you're still paying more than that, then what you're paying for is the goodwill. And you know what I would suggest is, you please go on the internet and search for balance sheet of Facebook. Well, it's called Meta now. So look at the balance sheet of Meta and look for goodwill, and hopefully you will be able to find somewhere around a figure of $19 billion, and that, my friends, is the goodwill that they bought from WhatsApp. This is another example for you, company A and company T, but I of course would really like you to focus on Facebook and Meta. However, if you like to just go through this theoretical example, here it is. So company A is buying company T for 100 million. Now this is what they are paying. The cost is what is the fair value, because the goodwill is going to be 100 million minus the fair value of company T. Now the book value is 125 assets, 75 liabilities, which means 125 minus 75 is going to be 50. But this has no meaning for us because this is the book value. We don't care about this. What we want is the fair value, and that is going to be 160 minus 75. So 160 minus 75 is 85 million. That is going to be the fair value, right? So 100 minus 85 is 15, and 15 is what you're paying on top, and therefore 15 is the goodwill of company T, right? Book values are not used. Now, both IFRS and US GAAP allow you to show goodwill if you have purchased it, right? Internally generated will not be allowed, but if you purchase it, you can show it. Now, goodwill is an indefinite asset, right? It has an indefinite useful life, therefore it will not be amortized, but it will be tested for impairment annually. And again, I would like to give you the example of Facebook and WhatsApp. Now, when Facebook bought WhatsApp, it paid 19 billion, right? So approximately 19 billion less of whatever expenses. So let's just say approximately 19 billion it is showing on its balance sheet as goodwill. And the auditors come in and they say, okay, is it still worth this much? Or is it still worth at least this much? And Facebook says yes, and it shows them their basis for saying that. Like, for example, maybe through WhatsApp, they are getting the data of the users and they are using that data for showing better ads or more appropriate ads to each user, and therefore they are able to generate more revenue from their ad business, which justifies the value of this goodwill on their books. But if, let's say, the Supreme Court of the US says that this use of data is invasion of privacy, and it tells Facebook to stop using that data, now this asset of 19 billion, then it's not helping them generate this revenue, and the auditors will, in their annual impairment review, will say, hey, this goodwill is not worth anything for you anymore, so please impair it, reduce it, write it down. And that loss, the impairment loss, will of course be shown on your income statement. Okay, so as an analyst, what you have to be aware of is that, let's say, if you're comparing two social media companies, and LinkedIn, business of Microsoft, versus, let's say, Facebook, business of Meta, and you're comparing these two businesses and you're choosing which one you want to invest in, naturally you want to make adjustment for goodwill, right? Because if one of them has a huge amount of goodwill on the balance sheet, the other one doesn't, then you can't really compare the ratios from their balance sheet like that. You need to make an adjustment. So you'll have to exclude goodwill from the balance sheet. And if there are any impairment losses on the income statement, then that will have to be adjusted as well. Now you might be thinking, why only losses? Why not gains? Well, because goodwill, once you record it at 19 billion, let's say, impairment review will only check for impairment, which means does it need to be reduced. But you cannot increase the goodwill. Just like you cannot record internally generated goodwill, you cannot increase goodwill that you have bought. It is only tested for impairment in the sense that is it at least worth 19 billion, right, or more, then you can show it for 19 billion. You cannot increase the goodwill. So therefore there will never be an impairment gain. It is always going to be an impairment loss for goodwill. All right, so we're going to stop this video here. And in the next one, we're going to have a very, very interesting discussion about financial instruments and how we show them on the balance sheet.